Good morning and welcome to our latest webinar, Debt Finance Funding for Future Growth in partnership with Clearwater International. My name is Shalene Begum, Northwest Editor, and your host for the next 45 minutes. So the funding landscape has continued to evolve and a wide range of debt-related products outside of traditional bank loans and overdrafts available to support growing businesses. From startups to scale-ups, the availability of debt finance is vital to businesses from across the region. In this webinar, our panel of experts will explore current themes in the debt markets and discuss debt finance options available to businesses to help make them more informed choice about their growth. We also hear about sector trends in the region and funders' appetite as businesses navigate through the current economic uncertainties. Before we kick off, can I ask our brilliant panelists to introduce themselves? And I'm going to start off with you, Richard, because I can see you first.
No problem. Richard Williams, founder partner at Tosca Debt Capital, or TDC, private credit fund based out of Manchester, launched in 2015 with fellow partner Gary Davison. Since that period, we've raised over 500 million, done circa 40 transactions, 20 realizations, and continue to sort of focus on the SME market from a regional perspective, but also with national coverage.
Thanks, Richard. Matt.
Yeah, hi everyone, Matt Christmas, partner in the finance team at DLA Piper based in Manchester. I also head up the UK leverage finance practice within DLA Piper and have the pleasure of working with all these people on the panel from time to time as well. We advise borrowers, sponsors, lenders alike.
Thank you, Matt. And James.
Hi everyone, I'm James Painter, Investment Director at Palatine. So in terms of my role, basically I'm involved in working on transaction all the way from doing the investment to an exit for us. We're a mid-market private equity house to be focused on technology, financial services, healthcare, and business services.
Thank you, James. And Tom?
Yeah, good morning, everybody. Tom Barnwell, partner in the debt advisory team at Clearwater. What we do is we help borrowers and private equity secure the right type of funding from start to finish, managing a process and managing all the lender interactions.
Thanks, Tom. And finally, Simon.
Hi, Simon Dixon. I head up the leverage finance teams across the north of England, based out of Manchester and Leeds. We provide the debt to a private equity transaction. It's a national business for us across London and different regional cities, and also an international business with offices across the various continents.
Thanks, Simon. So obviously, we're looking at debt finance and how businesses can fund for their future growth. Just before we get into more detailed questions, can we get an overview of the marketplace and what's been going on the last 12 months and how the landscape has changed? Tom, I wonder if you could start off with that overview of the marketplace.
Yeah, sure. Thank you. So the last 12 months have been, well, there's been a lot going on. The debt markets have reacted quickly to the macro events. The Ukraine war being the latest, linked to high inflation and higher interest rates. What we're seeing is a flight to safety and a flight to quality, and funders focusing on preferred sectors and to some extent to scale. That being said, for good businesses, there is still a variety of debt options available. It's important to properly understand your proposition in the eyes of debt providers, so you can speak the language that they need to hear in order to address the risks that third parties would see in your business. The types of funding that were available 12 months ago continue to be available now. There's been maybe a slight tightening of terms and I'm thinking of the level of debt that is available, and also thinking of the way it is structured and the pricing attached to it. But in general terms, whilst there's lots going on and the debt markets are reacting quickly, they are very much open.
Thanks, Tom. Can I throw the question to the rest of our panelists as well, because you're coming from it at different directions. So, Richard, what's been the appetite for funding like? What have you guys been seeing the last 12 months?
Yeah, I think I echo Tom's point in that you know, from a fund perspective, you've got to be sort of really conscious of those macro conditions. There's lots of volatility out there. So businesses that are exposed to supply chains, availability of labor rates, interest rates. So there's a real melting pot, and there's probably very few hiding places. So there's certain sectors that will be less exposed. And you probably find quite a feeding frenzy around some of those businesses whereby private equity interest or general acquirer interest and, you know, debt providers will gravitate to those sort of sectors and those businesses. Whereas then the opposite is true, that businesses that are more exposed to those issues, there'll be less appetite. That's really been a feature of the market. So I'd agree with Tom in that there is always capital available, but I think it's for selective credits. Our job is, along with the guys on the call, is to sort of pick those scenarios and, from our investor point, get the right risk adjusted returns. So, you know, that's appraising the risk and pricing it correctly.
Thanks, Richard and James. Talking a lot about private equity as well here. You know, what's been your experience?
Yeah, so I think from our perspective, given the sectors we focus on, continue to see debt providers open to a conversation and very supportive. I think that's both on kind of initial transactions that we do, but at Palatine we do a lot of buy and build, so acquisitions within our portfolio, and so we're seeing funders also looking to kind of back portfolio companies and platforms if they're looking at that buy and build, if they're looking at expansion plans. So where there's a strong business with a strong value proposition, I think that they're absolutely fine. I think the main point from us, we've always been sensible on leverage, given where interest rates have gone. I think the main point coming out of the last 3 to 6 months is doing some kind of sensitivity analysis around the cost of interest, and inherently I think that does probably reduce debt and leverage going forwards. But I think being flexible and running some different scenarios on interest and sensitivity analysis has been pretty key.
Yeah, you mentioned quite a lot of acquisitions and M&A activity. What sectors are we seeing that in?
Yeah, I think so. It wouldn't surprise you. It's kind of fragmented sectors. The main ones for me are technology and financial services, where we've seen a lot of activity. I think you're seeing there was a strong bounce post COVID, and shareholders have looked at considered their options, given strong valuations in the last couple of years.
Thanks, James. And same question to Matthew and Simon and Matt. Do you want to?
Yeah, sure. I mean, I'd agree with what James said there. We've seen a lot of bolt-on activity, people focusing upon their existing portfolio, because that's a much easier proposition to take to investment committee or credit committee if you already know and de-risk the business for a period of time, rather than taking on a brand new challenge. And we've seen that behavior before when we go through the various times in the cycle. So that's consistent with what you'd expect to see. We are seeing, again, a lot of processes that were sale mandates. They didn't necessarily get done last year in the corporate team. They may be flipped into a refinancing or recapitalization for the owner as well. Possibly there you couldn't meet the price expectations. Everyone was still maybe applying a 2021 valuation to their business, and yet for the reasons that Tom articulated at the start of the call, purchaser interest is cooling slightly. And I think with what James is saying there, the deals we've closed over the last 6 to 8 weeks across the team in the UK for sponsors or for lenders alike, there's been a predominance of bank senior lender propositions there. That's by no means to say the credit funds are not sat on the sidelines, not deploying capital. Like Richard said, they're looking to find the right opportunities to deploy and get the right returns for their investors. And indeed, we're pitching for one to work with Tosca at the moment now. So it's far from the fact that they're not in the game. It's just, I think, to James' point, if people are going to look at slightly lower leverage going into a business, be a bit more prudent, then it might mean that it steers a bit more activity towards the senior lenders, but only time will tell.
Thanks, Matt and Simon.
Yeah, I think on the acquisitions point, absolutely spot on from James. And so from a bank perspective, at the moment there's a focus on, can we support existing clients with their plans, as we were doing through COVID, helping existing clients to get through that. And as we come out and try to grow and invest, then as a lender, we are looking to support our existing client base and take them forward. So we've seen a lot of activity this year around sort of buy and build acquisitions, maybe refinancing some previous debt to put on a better structure to take the business forward. So that's been a feature of the year. I think just picking up the point on the debt, because we all see a lot in the papers around it, and to Tom's earlier point about being open, I think it's worth making a distinction between the kind of large cap and the mid market. The press reports on the large cap, and that's you sort of, you're underwriting large deal, etc. And as publicly shown at the moment, the markets are closed. There are things that are in syndication needing to be taken through. That's not a supply issue as it was in 08, 9, 10. It's essentially that flight to safety or that caution that people are taking, but there is liquidity around through the availability through private credit funds and through the banks. So it is a different proposition or different scenario than we saw in the financial crash, but we've seen that pause and that waiting. So the large cap markets are waiting at the moment. There's no sort of primary loans in the market. This year to date, there's been 48 billion of issuance across the European leverage markets. At the same point in 21, there'd been 121 billion. So that is a market that is pausing at the moment. But as Tom highlighted in the mid-market space, I think there is a desire to support people to continue that growth out of COVID. And with the mix of sort of senior lenders, there's a bit, there is a caution around leverage. Maybe the terms are slightly tighter, as Tom says. And then the debt funds that are offering a little bit more flexibility around that, perhaps a little bit more leverage, albeit tempered at the moment. There's a good mix of funding that's available for people with a good strategy to take it forward.
Yeah, but I guess I'm just jumping in on that for me. That Richard's point about the feeding frenzy around really good assets in a hot sector, that would then actually go against what we're saying about a lower leverage multiple, because you might need to put a bit more debt into the structure to make it work if you're the sponsor and you really want to buy it. So again, you can see that kind of bifurcation.
To your point, to illustrate it on a pricing perspective, Matt, the feeding frenzy point's a great point, because the report about interest rates going up and everything costing more, but around those assets that are quality, there is a push down in pricing because people are trying to win that. So it's kind of counterintuitive to where the market is from an economic perspective, but those quality assets can still attract good pricing because people want to invest stroke lend in those assets.
I think it's interesting the point you make, Simon, because I think to a degree in our market, whatever you call it, SME, mid-market, whatever, we're sort of followers of a trend that happens higher up. And I think in that large market where you've got those syndications that are stranded or trapped for whatever reason, the private credit funds have come in and solved those issues.
Absolutely.
The consequences that they've deployed huge amounts of capital, and they've got pricing that's probably above and beyond what's being priced in our space of the market. So then naturally the investor looks at that situation and says, well, that's a safer risk. It's getting better pricing. And then classically, that's the flight to quality. So you get a slight orphaning of as ever of the SME market, the mid market, because the investor says, well, I'll put my money in that with those larger funds that are going to get me that return on those higher credit quality businesses. Where that settles, we don't know. But I think as an investor, you've got to be mindful of that dynamic. But that is the case, that those larger funds have really made hay in terms of deploying into that dynamic currently, which naturally that's going to flow through to our market. So you're going to see, I would expect, in time, and maybe as ever there's a lag to these things, but leverage will reduce and pricing will creep up a little bit to adjust to reflect the risk that's associated with our space in the market.
Yeah, agree with
James, sorry, James, we're going to say something there now.
It was me actually. I was going to say that we're seeing funders taking different views as to whether the end market for our clients is linked to discretionary expense or non-discretionary expense. With non-discretionary expense, and you can think it around certain sectors. So James mentioned tech and financial services. I'd extend that to healthcare. I'd extend it to certain business services as well. But really, so that there are certain sectors where feeding frenzy is one way of putting it, and I agree with that it's easier to transact than others. That's not to say that if you're not in one of those sectors, you've got no chance. I don't agree with that as a statement. You've just got to be slightly more prudent in what you're asking for and very careful and thoughtful about things like projecting your affordability and serviceability of the debt.
I assume you need a good debt advisor, Tom, is what you're saying as well.
Yeah. That's a great point, Tom. I think on the consumer discretionary spend point, and that's where an advisor does come in, helping a business to shape how we position that in order to ask for either equity investment or debt. And it's a lazy view to go, and we have to, I'm being open here, we have to take this on with our credit team. It's a lazy view to go, oh, this business is exposed to consumer, therefore we should all batten down the hatches. What we try to do, and we get that input from you helping a client, is to pitch that individual business and where it sits in its market and what the drivers are, because it's not naturally a following that just because it's consumer related that it's going to struggle at this point. And so it's a great point.
Yeah. And can I just ask, if got businesses and logged on for this webinar and they want to find out, what's available in the marketplace, can you guys elaborate on, what are the debt finance options, and how can SMEs better prepare themselves to access those options, to accelerate growth, because the economy is very uncertain at the moment. We're now looking to 2023 and looking at growth over the next year. What should they be doing, and what options are available?
Sorry,
Sorry, go back to you.
I was just going to say, well, if you're thinking about it, the deals that are getting done are taking a bit longer occasionally, and there's more diligence and scrutiny being conducted by the lenders and by the purchasers as well for them. That's common sense. That's not earth-shattering at all. So if you're aware that you're going to go through a process or some sort of refinancing or an acquisition process, then you need to make sure you got your house in order as soon as possible, and you identify the risks or the questions that your lenders or potential funders are going to be asking of you. So if you've got a concentration in a couple of contracts, well, make sure you've looked at those contracts and see how robust they are, if that's underpinning a lot of the business that you're generating, because your lender's going to ask these kind of questions as well. So I think you can just get your own get your house in order and do that preparation early to make life as easy as possible through a refinancing process, rather than start a process and then find you hit a brick wall because questions that could have been anticipated if you've taken good advice on both structuring, on commercial terms, on legal terms, then actually you'd have anticipated this beforehand and make your life a lot easier.
Mm-hmm.
I think you if you reduce the friction that within a process, that you've got more chance of completing a deal but having more options available to you. So that is the cleanliness of the numbers, the preparation. So the lenders or the private equity sponsors, etc., having to do sort of less interpretation. And I think it doesn't pay currently in this climate to be overly creative with the way you present the numbers. The cleaner the numbers are, and importantly, the conversion to cash, because people will focus on cash, people will focus on liquidity. You go back to basics in this kind of market, that's going to help. Help the story, help the credit. So make it. Ease of execution, I think, is the point. So I'd say it doesn't pay to be creative currently. You don't have the same dynamics that we've had a market where it's debt's been relatively cheap. It's been a great tool to employ financial engineering tactics to enhance returns. I think that's a bit buyer beware on that scenario in terms of just taking on heaps of leverage. That can't be the central plank of your investment thesis. It's got to be broader than that. It's got to be more sophisticated.
Yeah,
so I'd say yes. Do your diligence, get your advisor on board, take the time with the numbers before you go out. Don't be premature taking it to people.
Yeah, I agree with that, Richard. I think from we are off a period where kind of you get EBITDA add backs in processes, and I think people are being more sensible on those. The focus is definitely on cash. I think from a broader perspective, you still got a lot of options. You've probably got more options now from a kind of debt finance perspective in terms of the actual products available. So whether it's kind of senior debt, mezz, unitranche, and you're seeing more of the debt funds coming down to slightly smaller check sizes than where they did do 3-4 years ago. So I think that the right debt for structure for a business is probably dependent on ultimate goals of the business. Is it on an acquisition strategy and wants to preserve cash to fund the acquisition? Hence, more of a unitranche structure might work. That gives you the flexibility. But I think for SMEs, there is a lot of options still available and different products that may suit their need.
Yeah, I'd add things like asset-based lending to that.
Agreed.
The product set, for example, that HSBC have got, I would imagine that there's more deals that are going into invoice discounting at the moment compared to 12 months ago, as an example.
Yeah, I think good point, Tom. There's the standard suite that we see in our kind of leverage loan markets, corporate loan markets as well. There's growing interest in products such as asset-based lending, as Tom says, and then I think sort of some of the banks and some of the funds are kind of allocating capital, as we said earlier, to specific sectors. So, with Support of Advisor, you can look and find access to something that's specific in your sector, growth lending fund, to the tech sector, for example. And I suppose the benefit of that is understanding of the sector. There's a slightly different, let's call it a modern approach to, potentially to that. There's a lot of chatter recently about ARR lending and which fits with the tech sector, given the dynamics of that. So there's a standard suite and the things we're all familiar with. James has highlighted those well, but there's equally a focus that you can see in certain sectors which might be right for you at the earlier stage of growth that the business is seeing.
I think relationships important as well. I think that's, I think through COVID, some of that was lost because everyone was sort of trying to do deals via Zoom for the right reasons. I think this kind of market, look at the people on the call, this deal's been done whereby, Palatine as the sponsor, HSBC as the bank, transactional banking, all the ancillaries provided. We've provided more term capital. Tom may have been the advisor and Matt the lawyer. Now, that's not to say it sounds a bit kooky, but you can, if you trust in those relationships, you can work on deals that are slightly more complex if you're open, honest, and talk about the issues that are presented there. Not every business has got a perfect credit dynamics, and it's unrealistic to think we're all going to wait for those that tick every single box, because that's not real life. But if you've got a grown-up approach, you can have discussions and you can talk about the issues and you can structure around them and mitigate them. That's really helpful versus trying to keep lenders, sponsors, remote, running really tight processes that don't share sufficient information. It might work in a very hot market, but I think as soon as it cools and the pendulum shifts a bit more to the middle ground, you need to take a slightly more whatever the right word is, but a relationship-based approach and be open, honest, rather than sort of carpet bombing the world and trying to get attention that way.
Yeah, I think
it's more collaborative, isn't it? Sorry.
The other point about when you asked about products, which we've all talked about, I suppose the other point is kind of what's the strategy that the business has got, because there are debt products that can only achieve so much. And if you have an acquisition strategy, there's a lot of corporates we back that start off on a debt strategy to bring in some acquisitions, but it can only stretch so far and it is more restrictive. So if your strategy is buy and build on an accelerated basis, then private equity is a turbo boost to that. So I think we have a suite of products, etc., in debt, but what is the strategy? If the strategy is a buy and build over a quick period, then maybe debt's not the right option for that. Maybe it is a joint relationship with another shareholder that helps to turbo boost that strategy.
Isn't that the great thing about Greater Manchester especially, is that there is a collaborative approach? So if that was the case, Simon, it's a lot easier to do in Greater Manchester because the panel, for example, today, it's that relationship that makes those deals easier to get through in the end. I had a question that somebody sent me earlier last week, and he was asking what is impact of moving out of low interest rate environment. If somebody can take that question on. And for those watching, we do have a Q&A button, so if you want to throw any questions to our panelists, please do so, and I'll make sure that they get answered. So so what is the impact of moving out of a low interest rate environment?
Well, the straightforward answer to that is the cash cost of debt is higher. And so therefore there is an increased cash burden on the business, on the borrower. And what does that mean for new deals? Well, we talked about it a bit before. It's the serviceability of that debt. And we've seen we were talking before about, is leverage as high as it was previously? The answer to that is probably not. And one of the reasons is because you want to keep the total level of debt servicing at a reasonably consistent level. And so therefore you have less debt for the same interest and capital repayment burden. There'd be a question around, is it the right thing to take out interest rate fixes, swaps, caps, that kind of thing? We're seeing more of our clients ask that kind of question. The interest rate forward curve has moved around an awful lot over the last 6 months. At the end of September, the expectation was that interest rates would peak at 6%. The expectation today is that they'll peak at 4.5%. So there's lots and lots of uncertainty in that market, but you boil that down to what does it mean for borrowers in the mid-market? It's be really careful about serviceability and assess serviceability under different scenarios to make sure that you can afford your debt if something that you don't expect to happen happens.
Thanks, Tom.
I think that just to add to that, sorry, I think Tom's views spot on. I think over the previous few years, we've seen in our markets in particular, and Richard and I endorsed this, a move to sort of lower amortization structures into bullet. And those, you know, the serviceability is just the interest cost at that point. So we've had a period where serviceability has been very safe and sound because, you know, there isn't any capital repayments going on, and you know, we've supported that and as a sort of evolution in the market in this space. But as you just say, that the focus that just came where almost overnight sort of forward rates went to 5.6%, all of a sudden sort of the lenders go in, well, I do sensitivities around revenue and cost, I probably need to run some higher interest rate sensitivities as well to check on that serviceability. So that's what's been happening. However, Tom's point was right. I think we all felt there's probably going to be a spike, and those rates were sort of fixed at, you know, forward-looking rates had gone to 5.6, 5.7%. So initial flurry of sensitivity work, there has been a settling down, as Tom noted.
It does come to vintages, doesn't it? So Tom's right. If you're doing a deal today, you can structure in these kind of dynamics, be it the cost of the debt, you know, the inflationary pressures, energy prices, labor rates, all that kind of thing. You can factor that in. It'll be considered in the diligence. It'll be sensitized. It'll be, you know, scenarios run, etc. The issue is those businesses that have taken on probably what in hindsight is too much debt when the interest rates were low, when we didn't have the same inflation, we didn't have supply chain pressures, we didn't have competition. So you're naturally going to get those businesses that are really struggling as a consequence of contemplating a deal when the market was very different. You know, what's the reality of that? You know, you'll probably get balance sheets that need to restructure, assuming the underlying business is still a good one, but it's certainly the case that it's more costly to run a business in this current climate than it was previously. It's a lot harder. You'll get management teams that are running ongoing 13-week cash flows to sort of determine what liquidity they've got, and definitely with eyes on needing to do something. And that's where, you know, transaction activity will probably shift a little from being sort of M&A driven positive events to now some aspects of restructuring. There's always a lag, but that will come through next year. It sort of has to, because of the pressures that have been put into the system on the back of COVID, and now with the Ukraine situation. You know, the collision of those factors will inherently sort of test out teams and businesses ongoing.
Thanks, Richard. I've got a question here.
Totally agree. It's not going So I just finish off on Richard's
Sorry.
point there. I agree. It won't be pure M&A, new money activity, deal after deal after deal. Everyone's going to be a bit more flexible. The debt that was taken on through COVID doesn't just disappear overnight. Something needs to be done with it, whether it's amending and extending the terms, gentle restructurings here and there, whatever it may be. Like you said, Richard, there's going to be a bit more flexibility. There needs more advice and collaboration around products to get the capital structure right for these businesses, whether that's a combination of asset-based lending, where the received wisdom is in a downturn, lenders like that, it's actually a bit cheaper than traditional overdraft facilities. They're closer to the assets. Everyone's short on their supply chains to deal with those issues that Richard and everyone else has mentioned. So they're sat on stock. You can fund that, and that ties up your working capital. So it's not just invoices; it can be the pure borrowing-based type facilities as well. And there's a lot more independent players now in the mix on that side of things as well. So it's looking at all the options available to borrowers out there to work out what is the right funding structure for them as we go through the next period of the cycle. So as long as everyone's got an open mindset as to what that might look like, and people are prepared to collaborate and work together on tie-ups, on Richard providing a bit of debt, Simon providing some other debt, and then another person providing some working capital through an ABL line or something like that, and Tom sat in the middle trying to choreograph all of that and bring it together, that's, I think, what you're going to see a bit more of over the coming months and years.
Yeah, and you don't have, you had furlough, you had CBILS, you had RLS. Those things don't necessarily exist anymore, but you've still, management teams still have issues to work through, but without that support, and if anything, with the liability of those of that government support still on the balance sheet that needs to be repaid, there's a phenomenal amount of money that went in through that scheme.
Just making sure SMEs and businesses are being proactive as well, not hiding when the challenges come their way. I've got a question to the panel here from John. He says, I recruit a lot of CFOs, FDs into SMEs, PE-backed companies. When an application for funding, credit or debt or an investment deal falls over, do you see any commonality in why that is, where the lack of quality of financial information is perhaps? So yeah, do you see any commonality?
Happy to give a senior lender view. I think it's, there are lots of different reasons, but I think to a point that was made earlier by several of the panel, it's about the preparation of that. So if you're going to go into a process, working with an advisor to prep the business properly. When we look at diligence report, it's about the numbers, the figure, understanding the business, etc. But there's a section in that talks about how easy was it to access information in the business, how much of that information was available, how granular was it. It's not just around gross profit is X, gross margin is X. It's sort of, can that be broken down into the different component parts of the business, if it's different divisions, if it's different areas of the business, is the quality of information such that it can tell the story to an investor like James or to a lender like Richard himself to understand that. So for me, it's about the preparation with the advisor gives the best chance of success.
Yeah, I agree with that, Simon. I mean, from our perspective, the financial information is helpful, but it's also the operational KPIs and having a small number of metrics that you're assessing, and you can tell the story of the business from what it's performed historically and where it's going to get to. I think the other point I'd add, and Richard's raised before, is around relationships. So having lots of conversations with a wide number of parties probably isn't the way forward in terms of trying to get a deal completed. It's probably more having a smaller handful of conversations of people who understand your business and your sector, in order to that probably puts you in the best place of completing a deal.
Thanks, James. We've just got another question that's come through from Stephen. He says, we are reading and hearing that there will be a tremendous amount of business failure from January of next year. Will this give us a wide opportunity to buy and fund the quality ones that we feel can be rescued?
I think for well-funded businesses, well-capitalized businesses that have available, that have access to liquidity, and be that they're allowed to draw to 3 times leverage and they're only at 2, for example, then there will without doubt be opportunity. Is there going to be lots and lots of business failures? Time will tell, but there will definitely be opportunity for well-funded businesses.
Thanks, Don. Just looking at 2023 as well, This is a question from a manufacturer that emailed me this morning. It's asking, will debt finance be harder for businesses to get in 2023?
I think it
Yes.
touches on a lot of the things that we talked about before. Going on to question but 2 ago, the only certain way of failing is by producing bad information. No matter how good the business, if the information doesn't support what you're asking for, then you won't seek it. Manufacturing, is that an easy sector to raise funding for at the moment? I'd suggest you'd need to have modest funding aspirations, but assuming that you structure it correctly, that should be available. So we talked about asset finance and equipment finance. For manufacturing businesses, they're highly relevant.
Thank you. Yes. Just again, looking at the future, it sounds like there's liquidity in the market. There are opportunities. We've got a great collaborative corporate finance community in Greater Manchester. So looking at next year, what would you say to SMEs that they could be looking forward to in terms of what's out there, how they should be growing the business, what they need to be doing in terms of preparing for funding? You guys work across different sectors and coming out from different viewpoints. So what would you say businesses should be looking forward to the most in 2020? Because it's still optimistic, it's not completely doom and gloom, is it? Richard, I'll start with you.
No, I think people need to that first and foremost, it's back to the point about the preparation. If they've got a business plan, it needs to be fully thought through. They need to sort of look at the drivers of that, look at what capital's required. It needs to be equitable. It can't all be on debt. That's not a logical place to be at the moment. So you need to get your structure right. It needs to be prudent, and then you need to determine what's the best source of that capital. Is it an asset-based structure? As Tom says, if you're manufacturing, that can lend itself nicely. Is it a term facility from the bank at more conservative leverage levels, or is it a fund option that might be more flexible, alongside kind of sponsor equity investment from the likes of James? So I think all of that it's preparation. Take the time, get control of your own facts and story, consult with an advisor as required, provide diligence and information to the lender so that they can do a proper analysis. I think it's difficult when the question comes early, it's not fully formed. At the moment in this kind of market, it doesn't serve the likes of ourselves to take a leap of faith on half-baked information. It needs to be fully thought through, and the evidence of that is, as Matt says, deals are taking longer for that very reason. So the key is the preparation. Good businesses, good opportunities will get funded, but take care with your proposition really, and communicate it correctly.
And I'll just finish that off and flip it slightly. So even if you are struggling as a business for all the reasons everyone else has articulated on the call, early engagement is essential. Okay, so your chance of success for a good outcome, if you're going to go ask for like an acquisition type arrangement, it's getting your house in order, as Richard and everyone said, preparation, getting the numbers right and everything else. If conversely you're struggling for whatever reason, it's not fault of your own, it's a macroeconomic thing, there is a good business there as well, but you need to put in some I won't say emergency funding, but you're going to have some sort of additional requirements for funding in the future to some greater or lesser extent. Early engagement is critical. I'm not a restructuring partner, but my restructuring team, the biggest bane of their life is when people don't come to them early enough. Because if I'm sure the people on this table as well would want early engagement with one another and experts to try and work out what the solution is, because sometimes time can be the critical factor.
It's also true that the grass isn't greener in that situation. You get plenty of sort of opportunities as it are that my lender's not being pragmatic enough, and the best answer if you've got an incumbent provider of capital is often going to be a solution with that incumbent provider of capital. You're going to find probably very minimal difference between the appraisal that goes on from the people on this panel. They're going to read it in pretty much the same way. So engage early, yes, and engage with your stakeholders and capital providers if it's a scenario that's more in that stress camp, because taking something out to market at the moment and thinking that the grass is green is probably not going to be true.
James, same question to you.
Yeah, I mean, I think the guys are clearly, more knowledgeable from a debt perspective. But looking at it within a more of an equity kind of lens, I guess I'd say the couple of key points are really around being able to articulate your value proposition and points of differentiation. So really being able to articulate to an investor what your story is, where you want to be in 3-4 years, is really important. I think the other kind of trend, and we've focused on it at Palatine for 10 years plus, is ESG and sustainability. There's no doubt that's kind of got higher up the agenda of a lot of board meetings and businesses. And I think we've moved from it's always been the right thing to do, but from our perspective, it's not just the right thing to do, but actually it builds better businesses. And if you look at a couple of aspects, so energy costs, doing the right thing from trying to save energy is the right thing for the business given where the energy markets are. Equally from a people perspective, ensuring kind of really strong quality and culture within a business is really important, because in the sectors that we're in, we've seen a strong war on talent, so recruitment and retention is pretty key. So I think that will continue to get higher and higher up the agenda, and it should do in the future.
Thanks, James. And Tom?
Yeah, I draw some parallels with the COVID period. The debt markets for new transactions immediately post-COVID were pretty quiet, a lot of inward looking, focusing on portfolios, what's going to happen. And there became a point where people looked up again and started to do new transactions. I think the last few months has certainly been a period of uncertainty and volatility. If you wind that on 3-6 months, what you'll start to have is evidence of how funders are impacted by higher inflation than they've been used to, higher interest rates than they've been used to. And as Richard was talking to, there was lots of deployment from direct lenders over the last 12 months. The direct lenders will require to lend again next year, and so that will help kickstart the appetite. There are processes which are being held back at the moment. They won't be held back forever. So as more certainty is brought into how businesses react to the current environment, then more businesses will come back to the market, in my view.
Sounds like it's going to be a busy quarter for deals activity going into 2023, doesn't it? And Simon?
Yeah, I do hope so. We always hope so. I think the points made are valid around both, businesses that are well funded and got facilities available. To Tom's point, people had to pause things through COVID, and if you've already got the facilities in place, e.g. committed acquisition facilities to go on a buy and build, then there will be opportunities, as we've highlighted, to pick up some businesses at good prices in 2023. So we hope that will stoke the market and provide opportunity. And equally, to Matt's point, that there'll be many looking, maybe a bit of struggle and stress. So early engagement broadens the options available. And again, there's a plethora of funders in the direct lending market and in the high street banks that are available to look at that. I echo that your incumbent provider is your first stop and a good stop, but equally there are other options around as well. So that combination hopefully will see us into a sort of plethora of deal activity across the first half of next year.
Thanks, Simon. And that's what brings our webinar to a close now. Thank you so much for attending today. Thank you also to our brilliant panel for their insights. Thank you also to Clearwater International for working with us upon this webinar together. There will be a follow-up write-up on the business desk next week, so please do look out for that, and there'll be a recording of the webinar that we will share. Thank you again for your time, and I look forward to seeing you all again. Thank you. Bye.